Hi, first video in a long time. I think it's been about 2 months or something, 3 months since I made my last video. Um, but now we're getting some interesting things that are happening. So the first thing I want to bring up is uh, I believe we are 100% in a recession right now, but they will not let you know until 12 months from now. Okay, why am I saying 12 months from now? Well, because during 2008, the recession began in, you can see the gray bar here, it says shaded areas indicate US recessions. It began in December 2007. Right here, the gray bar appears. But the NBR, which defines recessions, did not tell you that until December of 2008. But how is that useful? I mean, if you look at that, right, December 2008, where's the stock market by that point? I mean, it's down 52, 53%, right? So it gives a shit about what these people have to say about whether we're in a recession or not. We need to look at leading indicators. The leading indicators would obviously be the yield curve, which I've been talking about for the longest time. What does the yield curve actually predict? It predicts a rise in unemployment rate. Okay, very simple stuff. So I, again, you can go back and look at my videos. Been talking about the California unemployment rate. What's interesting is if you go back and look at my videos, when I made these videos around here, September, October of last year regarding the California unemployment rate. This was 4.7%, which means they've gone back to they've been revising the data, right? Which is actually a very, very bad sign because it means that everything is way worse than what it actually is. They did the same thing during the 2008 global financial crisis cycle as well, right? So what I want to cite primarily is this. Every single time we go 0.6% above the cycle low, you can see these are, historically speaking, always recessions. This just triggered in May of 2024 now. You may not think that's a big deal, right? Again, it's about the trend from 3.4 up to 4%. You might say that's still very low, right? Uh, how long did it take for the recession to begin after the unemployment rate rose the same amount? From May of 2007 until December of 2007, the unemployment rate went from 4.4 up to 5%. Shaded areas indicate US recessions. Is there a gray bar here? In December of 2007? Yes. What does that mean? Recession. 0.6% increase in unemployment rate led to a recession. 3.8 up to 5. No, 4.3. Yeah. So a 0.5% increase in unemployment rate, recession. What about the example before that? In 1990, 5.2 up to 5.5.3%. If this is not a recession, I don't know what is. Okay, this is this is going to get continuation. Okay, they curve out these bottoms and it always leads to a spike. The largest type of population was a leading indicator, and also again the yield curve indicator, right, which predicts recessions as well. And again, the yield curve is simply just a spread, right, between a longer term interest rate minus a shorter term interest rate, which means that if you're lending your money out for a short period of time, you're currently getting a better yield than for a longer period of time. So, for example, for 2 years, then 10 years on an annualized basis, right? Which doesn't make sense. You should get a better return for lending your money out for a longer period of time. Why? Because there's more risk associated with it. There's the inflation risk. They might not pay you back, etc. Right? But currently, that's not the case. So, going back to this, you can see the same signal we had here. Uh, Months between 0.6% increase in unemployment rate and the start of the recession. 0 months. It says one neighbor is actually zero. We were in it. So in the past 4 times we were in a recession when it went up this much. We're looking at lagging indicators now, which everyone wants to look at, right? Okay, well, the labor market is starting to break. And it's not going to get better from here. It rose from May 2007 until October 2008. Okay? No, 2009. So May 2007 until October 2009. From 4.4% up to 10%. Historically speaking, all it takes is a 1.5% rise in unemployment rate for a stock market to crash by 50%. Okay, in the past three examples. How do I know that? If you look at when I mouse over this, you can see the valuation up here. This was the cycle low at 3.8%. By the time the stock market went down 50%, the unemployment rate was 5.8%. Again, valuation here, 5.8%. So a 2% increase in unemployment rate led to a 50% stock market crash. What about right here? Cycle low 4.4%. By the time the stock market was down 50% over here, how much was the unemployment rate? 6.8%. If you want to take from here to here. 47%, 6.5%. So around a 2% increase, 2 to 2.5% increase, crashed the stock market by 50%. What about the example in 1973, 1974? I'm bringing it up because that's the third 50% stock market crash we've had in nominal terms, right here when it went down. From 4.6% to the bottom here, 6%. A 1.4% increase in unemployment rate crashes stock market by 50%. So you can say that, oh, I don't care if it just goes up a little bit. Again, it curls out these bottoms. It's a very clear pattern. The same thing always happens. Okay, the yield curve inverts. Right? The yield curve inverts. The yield curve inverts. Regular candles. Anything below the green horizontal line is inversion. It's inverted. Re-steepens. Unemployment rate rises. It's inverted. Unemployment rate rises when the yield curve re-steepens. Unemployment rate rises when the yield curve re-steepens. Unemployment rate rises when the yield curve re-steepens. What do you think this is going to be? It's going to rise and the unemployment rate will follow. That will lead to forced selling. There you go. That's when you get your stock market crash. So again, I'm bringing this up because there's some interesting updates here, and I'm gonna continue updating you with the California unemployment rate and whatnot. Full-time job losses. Last month we lost like 600,000 full-time job losses or full-time jobs. Um, and again, the problem with the national unemployment rate, you should actually look at U6 if you want the accurate number as well. It's actually higher. U6 is this. U6 actually counts the accurate data, and this has gone up 0.9% from 6.5 up to 7.4. Now, what's the difference between the national unemployment rate and U6? The national unemployment rate does not you drop out of the unemployment rate statistics if you're unemployed for 12 months or more, and if you have a part-time job for 2 months, for 2 hours a week, then you're also you're not unemployed either. Like for example, if you drive for Uber or something, right? So I figured this would be interesting to go over. Don't really have anything else to share here. Plus, I'm gonna go bed in a sec, so I don't wanna go over some more stuff here, other than looking at pure technicals on the S&P, which is the last thing I'm gonna do. Uh, and what we have here, I thought this was interesting. Before COVID, okay, if you go to a line chart, what is that? That's a higher high, right? Higher high in price action, lower high. You saw what led to a bounce? Hidden bullish divergence led to one more bounce, which led to a bearish divergence, right? Hidden bullish divergence led to one more bounce, which led to currently a bearish divergence, okay? Again, here's the divergences. I'll just outline them quickly, right? So they appear all over the chart. You can say that they don't matter. That's perfectly fine. Do some research on what a divergence means. I'm not going to go over it right now, but this just means that fewer people are pushing up the stock market. There's two ways for them to do it. Number one, either they're using more leverage, which is not necessarily a great thing, or number two, uh, again, fewer market participants have more money, and you should likely not trust that move because it's likely a manipulative move. Okay. Uh, Same thing happened before COVID. Okay. Now we have this on the weekly chart. This is the weekly chart. We have it on the monthly as well. What I mean by on the monthly, multiple drives. Here's a high. That's this reference point in a vertical line. And then we have this, which is a higher high on price, but a lower high on the other side. Right, so you can see it here. Higher high, lower high. And then these connect over to here, where we're making lower highs as well. We keep making these higher highs. Okay. Multiple drives of bearish divergence. What about the 3-month chart? Multiple drives of bearish divergence. That's what the chart looks like before it drops off of a cliff. Okay. 6-month, same thing. Hidden bullish divergence, regular bearish divergence. Okay. 12-month, same thing. Hidden bullish divergence, regular bearish divergence. So that's the technicals. It looked like this before COVID. Again, this is my opinion. Don't really give a shit about when it turns around. All I'm telling you is just what the technicals are showing us, and this is exactly what happened before COVID. Not my opinion. This is a objective fact in the chart. If you are not happy with that, that's fine. Doesn't really bother me. That's just what this means. Right, that's all. One last thing actually. The DXY looks so fucking bullish. These equal lows here, deviation below, took out the range high, came back down, reclaimed it. If you break above this, next resistance is up here at 114, 115. If you break through 120, 121, that's very bad. Why? Because during the 1980s, they went through with the Plaza Accord, which was a agreement to devalue the US dollar against relative to other currencies by 50% because it was destroying the world. If this goes above this level, people are still going to have to service their dollar denominated debt because during the SIRP era, Syrian policy era, they were taking out dollar denominated debt because the euro dollar system, dollars are created inside of the US and outside of the United States as well. And if this goes above here, they're not going to have an option. They're going to have to buy, and this will likely short squeeze. Okay, so yeah, that's this chart. And we have a 1 week hidden bullish divergence right here, along with the bearish divergence on SPX. Lower low, higher low, hidden bullish divergence. Okay, I think that's all. I'll update you on, again, the yield curve is officially correct again. The unemployment rate is rising. We are seeing the same signals as we see every single time when we're in a recession. This is no longer speculation. Okay, it is happening. The yield curve is officially correct. The yield curve does not tell you how much the stock market is going to go down. It doesn't tell you how much the unemployment rate is going to rise. It tells you that the unemployment rate is going to rise and there's going to be economic contraction. The severity of the inversion means that more people are concerned. These people are not poor people. They are the richest people in the world. It requires trillions of dollars to move the yield curve. So again, that's something to look at. They are never wrong historically speaking. Again, with the money supply as well and everything. Yeah, money supply contraction, which should lead to deflation Q3, Q4 of this year. All right. Anyways, that's all. Peace.